maintain that Q4 exit margins will be 25%. This was their guidance. Q4 margins will be at 25%, but it's fallen short of street expectations on margins. So margins are a clear miss. Margins flat on a sequential basis versus expectations of an improvement. The other number that we have is the rupee revenue growth. At 59,162 crores, it's falling short of our expectations. It's a revenue growth of 1.6%. Missing estimates by 300 basis points. But at the bottom line, there appears to be a beat. So profits, consolidated profits at 11,392 crore rupees is an improvement of 5% on a quarter-on-quarter basis, better than what we were anticipating. So need to understand what has led to the profit beat at a time when the margin performance is a bit of a miss. So these are the three numbers. The key number in that is the margin miss. Awaiting the constant currency revenue number, awaiting the dollar revenue growth number. These are numbers that we don't have. And in the internals, the key will be the BFSI performance, because we've been talking about the banking, global banking turmoil. So what is the BFSI performance this time around? Are there any other pockets of weakness? And finally, we're going to be watching out for the supply side situation. Attrition had ticked down by 20 basis points in the prior quarter. Does that continue? And secondly, on the headcount. Last quarter, TCS's headcount came down by 2,000 employees on a sequential basis, and this has never happened this rarely happens in TCS's performance. Let me quickly run you through some more numbers before we get guest in. For Q4, the dollar revenue growth has come in at 7,195. So this seems slower than what the street was anticipating. $7,195 million is the dollar revenue growth. This is a growth of 1.7%, missing street expectations. So there is a modest miss on the top line. There is a miss coming in on the margin front as well. The headcount number is at 6,14,795. So this is a slight increase that we've seen on a sequential basis, but it's not a big jump. 821 employees is what it's gone up by. Attrition number has come down substantially, 120 basis points. 20.1% is the attrition that TCS has clocked in, which compares with 21.3%. So attrition has seen a very sharp fall. But there is a miss on the revenues and there is a miss on the margin performance. BFSI growth has slowed down for the third or fourth consecutive quarter. BFSI growth is now at 9.1%, which compares with 11.1%. So that's another area of miss. Anyway, the street was worried that BFSI is slowing down, but BFSI has gotten hit once again. Manufacturing growth is coming at 9.1%. This was an area that the company had flagged off last time on account of higher energy. Manufacturing is slowing down, and it appears to have grown slower than the company average this time as well. Retail is doing very well. Retail outperforms the country's overall growth average at a 13% growth. It's slower than the 18-19% growth clocked in the prior quarter, but it's still a pretty substantial growth. What is the number that we're still awaiting is the dollar, the order book. The order book has come in at $10 billion this time. So even as there is some issues with the near-term visibility, the order book continues to hold up very well. $10 billion is the company's order book this time. Very, very strong. Let me get in some reactions to these numbers. Moshe Khatri is here with us on the show. Moshe, are you satisfied with the performance compared to our expectations? It's a miss on the revenues, miss on the margins. BFSI is slowing down for the third or fourth consecutive quarter. But on the flip side, to counter this, you've got a very strong order book, $10 billion, a substantial pickup on a quarter-on-quarter basis and higher than the company's own guidance of $7 to $9 billion. And attrition is coming down at a rapid pace, 20.1%. So in a way, it's getting counterbalanced, but I think the growth numbers could disappoint the street. Your thoughts?
It's good to be here with you. It kind of reminds me of Accenture's numbers. Accenture had very strong bookings, and then on the other hand, they went out and took numbers down for the fiscal year. So I think this is where we are now, right? We know that the booking numbers are going to be pretty solid for the group. We know that sales cycles remain relatively long, and that impacts visibility. It seems that rather than things picking up in the June quarter, this seems to be more of a back-end loaded year from a calendar year perspective. So, it's kind of a mixed quarter. We knew that the quarter is going to be seasonally weak. I don't think there should be anything kind of new there. But again, if you're looking for some bright spots, it's definitely the booking numbers. It'll be interesting to see the mix between renewals versus new logos. Obviously, that's going to be important. But mixed quarter, we call this this is kind of in the bucket of what we call better than feared kind of result, if you will. Weak numbers in the near term, but then the booking numbers strong. But ultimately, all these have to be converted in order for us to get that uptick during the second half of the calendar year.
Okay. We have Mithul as well joining in on the show now. Mithul, wanted to get your first read on TCS's numbers and how will the stock react tomorrow?
The initial numbers indicate there is a clear-cut miss on revenue side as well as margin side. More surprising element is as attrition is coming down sizably. Despite that, there seems to be a cost pressure as well as probably some pressure on the pricing side, as company might be trying to maintain revenue with a lower average pricing. So on both the counts, there is a miss, and as you pointed out rightly, BFSI being the major segment contributing nearly 31 to 32%, there the growth has come down to single digit now compared to earlier range of 11 to 15%. So these all indicates kind of a negative sentiment, negative developments. Despite there is a strong order deal win you indicated as 10 billion plus, but we believe that going forward due to this Europe and US slowdown, conversion to revenue or execution would get delayed. So revenue impact would continue at least in first half FY24.
Do you, Moshe, are you surprised that the company has missed the performance on margins? Because TCS had clearly guided for exit margins of 25%. This is a very conservative management. They rarely put out a number unless they're confident about meeting it. And we know the supply side situation has eased. Attrition, for instance, is down 120 basis points quarter on quarter. The headcount addition is marginal, about 800 employees added on a quarter on quarter basis. Then why is it that we're not seeing an improvement in margins on a sequential basis and the company has had to miss its margin guidance?
TCS is a very conservative management team. This is a management team that knows how to operate really well. I don't disagree with that. We'll have to get some details in terms of what impacted margins. Could be that the company continues to invest even in this environment. That's a possibility as well. Could be some other things like FX, but beyond that, I don't disagree with you. This is a bit unusual.
Okay. Mithul, the street expectation is that in FY24, margins are going to improve on account of easing supply side situation. If the Q4 exit margin is a miss, do you think this whole thesis of margin improvement may be a bit overstated in FY24 and there could be downgrades in store for TCS?
Certainly, this margin miss probably will at least restrict analysts from upgrading the margin expectation for next 2 years. But we would wait for the management commentary, as most people on the street as well as we are expecting there would be a cautious commentary for FY24 considering this delay in execution, or most of the management also highlighted that these clients are not taking the decision for the forthcoming deals or major orders. So all those commentary as well as BFSI outlook, what is company's point of view, those would be the major deciding parameters on FY24 revenue as well as margin estimates.
For those of you who've just tuned in, let me quickly run you through the TCS numbers because the press conference is about to begin. TCS misses the mark on revenues and margins, so the street is going to be disappointed by this performance. Constant currency revenue growth has come in at just 0.6%. versus estimates of 1%. Dollar revenue growth, 1.6%. Estimates were for a 1.92% top-line growth. Margins are flat at 24.5%, missing the mark of margin expansion. The street was hoping for a margin expansion of 50 basis points, and TCS itself had guided for exit margins of 25%. So it's surprising, the margin miss, considering that the attrition has come down by 120 basis points on a sequential basis. Generally, the cost and wage inflation has been on the lower side. This is what we picked up from the industry. So then why is it that it's not reflected in margin expansion? On the flip side, order book is holding up very well. The order book has come in at $10 billion in Q4, which compares with $7.8 billion. And for the full year, the company has seen order wins of more than $34 billion. So this is a big positive, the order book number. And for instance, this FY23 order book number of 34.1% will compare with FY23's number of 34.6%. So FY22 and FY23 order book numbers are largely similar. BFSI is going to be a bit of a bother for analysts because BFSI contributes more than 30% to the overall revenues, and here the revenue growth is slowing down. So BFSI growth this time has come in at less than 10%. It's closer to the 9.1% mark, which compares with 11% in December, 13% in September quarter, and closer to 14% in the June quarter. So BFSI has been serially declining for the last 3 quarters now, and this is going to be a bit of a worry. The headcount addition continues to be fairly moderate. On a sequential basis, 821 employees have been added. So missed revenues, missed on margins, but the order book continues to hold up well, and BFSI is a bit of a spot of bother. Moshe, any more details that you would like to add to us? And just wanted to understand, how should we read this order book number of $10 billion? Is it because we are seeing more cost optimization deals rather than discretionary deals, which is why the number is looking big? And what could explain the miss on the execution front as well? Just a constant currency revenue growth of 0.6% in your assessment.
Well, the pipeline is definitely shifting towards cost optimization deals and opportunities related to vendor consolidation. This is kind of the bread and butter for a lot of these companies. So they know exactly how to do it really well. They know how to cut costs for enterprises that are looking to do that, especially given the macro. So it seems that the whole pipeline is kind of pivoting there. And again, that should be to their benefits. Again, the challenge is going to be about converting these deals. Remember, the booking numbers look good on paper. They're not engraved in stone, and they still need to get converted. And this is really the challenge that many, many companies are going to have when they will provide guidance for the next few quarters. Because again, the sales cycles remain a bit kind of long, they're unpredictable, and you're almost making here a macro call in terms of what happened in the global economy. Again, I'm not sure exactly what happened in terms of the revenue miss, but it almost feels that some of it is a function of what happened on the BFSI side of the business. We're not where we were in the 07, 08 timeframe when banks were structurally flawed. You can probably argue that in general, banks are in much better shape, but you do have some, experts predicting more trouble on the financial side of the business for many, many banks. So we'll have to see where it goes, but I won't be surprised if banks are probably pausing some of their spending initiatives, and maybe this is probably one of the reasons why you've seen that miss during the quarter.
Mithul, press conference is about to begin. We will hear from Rajesh, NGS, the CEO designate, Kriti Vasan as well, and Milind and Samir will also be there. So we'll have the full, top band of TCS joining in. What would be the top 5 things that you would want to hear from the management? For me, one of them is going to be the reason for the margin miss and the weaker execution on the top line, just a 0.6% revenue growth. But what would be the other factors that you track?
Yeah, certainly this, despite there was a currency tailwind, why margin miss is there. And as you pointed out, employee net addition is also almost negligible. So there is no cost pressure, and still they are not able to convert that into margin expansion. Secondly, BFSI related more details in terms of what is their exposure in the US banking system and what is the outlook there. Thirdly, overall, their outlook on the particularly Europe and UK side, where people are more worried about this. And lastly, on this, again, employee addition for FY24, what kind of headcounts they are indicating for FY24, and margin-related impact from the currency side.
Moshe, Mithul, thank you very much for joining in. We're going to